Welcome back, everyone. I hope you enjoyed your lunch break and are now hungry only for more information. You have met our next speaker already in the panel discussion. We touched on his topic earlier, but he will now do a deeper dive for us. Today is about finding opportunities, and with the circumstances as challenging as they currently are in the Eurozone, there's of course even more reason to seek opportunities in developing countries, in emerging and in frontier markets. In the aggregate, emerging markets have experienced higher growth rates over the past 20 years than developed countries, but of course, aggregate numbers are only part of the story. As for the rest of the story, you will hear it right now. So raise your hands once again, please, for Remy from MSCI. Thank you very much for being here.
Thank you very much. So we'll try to cover a topic which hopefully will be a little bit more upbeat in nature than a crisis, and we'll be talking a lot about growth, economic growth, the nature of it, the link with equity return. We will obviously discuss risk, as risk is part of the nature of investing in emerging market, and we will also look a little bit at the way the institutional investors are actually investing in emerging markets, the various paths that they use to structure their portfolios. So before we get to the sort of upbeat element, it is definitely emerging market tends to be also an area where there are regular crises, and reflecting on some of the comments on the euro crisis, just to put things in perspective. I had the nature of our business is that we're really much part of the definition of emerging market when it gets to institutional investment process, and as such, we're involved in discussing with regulators around the world. And I can remember a few years back having regular discussion at the time with the Pakistani authorities at a time where there was some tension in the country. And the problem they had to deal with was literally crowds storming the stock exchange and destroying the infrastructure. So we're talking about very different types of crisis, much more extreme, very different than what we've been discussing this morning. But at the same time, we're also talking about extremely dynamic economies. If we look at the opportunity set available to investors, we've moved from something which was extremely tiny 20 years ago, less than 1% of what was available for investment in equity, to today a weight for emerging market which is roughly 13%. And that is actually hiding a bigger economic number, because those reflect the shares that are available to foreign investors. If you look at the aggregate market capitalization of emerging markets, including the family owners, the governments, and so on, then you're at a much higher level, which is closer to 30%. 25 to 30%. So a much more expanded universe, which has been essentially expanding, not necessarily through or not by price appreciation only, but really through the extension and the opening of countries throughout the years. There's been a number of elements from the end of the Soviet Union and the Eastern Bloc that created a number of openings in markets, to generally a phenomenon of financial liberalization and a desire for many countries to have foreign investors bringing money to develop their economy. So through time, and the chart is more trying to illustrate that it has been done on a regular basis, but every second year, third year, there is a new country opening, and that phenomenon is not really ending. So there are a number of countries that are still partially closed to international investors. We'll see that in a minute. One of the common, sometimes misconception about emerging market is the way emerging markets are defined are very often a combination of countries with economic potential and development on that front, but there's also an element of accessibility which is present in the definition. So they're not only countries that tend to be less developed in terms of economies, but also very hard to access. And that definition is essentially captured with, in our market classification framework by looking at the GDP, or actually the GNI per capita, so a measure of economic development, a measure of the size and liquidity of markets, and a measure of accessibility, so how easily can you get in or out of a country. And it's very often in that third dimension that there are the most issues, but also that's where you can see the biggest change, because they are very much driven by regulatory changes or essentially political desire to open or not, right? So the timing of the opening is pretty much a policy decision. If we look at the emerging markets today, and we look at some of the countries or segments of market that are not open, we can see that today the emerging markets are dominated by a few countries, mostly Asian, and China being the largest, but other countries like Korea, Brazil, Taiwan represent a big share. That has not been always the case. So if you look at back 20 years ago when the emerging market index was created, and there was almost no representation of Asia because most of the markets were completely closed. If we look at what is closed today, but are markets that are properly functioning, you see that there are really at least two or three segments that could potentially, over time, as they open, join the emerging market index, and in particular the domestic segment of China. So when you look at Chinese opportunities today for investors, they are very often listed in Hong Kong, and what is available to domestic Chinese investors are not really open, or they're open but through a very cumbersome quota system, which effectively makes it very complicated for investor to invest in. But that segment, which is a very liquid segment with a lot of companies already listed, is available to local investors, and there are a number of discussion and policy, not yet decision, but statements looking at opening the market for foreign investors. So if we project ourselves, a few years down the road, and if you assume that the policy changes that the authorities are claiming that they are going to put into effect are in effect, then there is still quite a large segment for China that may be incorporated in the emerging market index. Saudi Arabia is another example of a fairly liquid and large market that is completely close to foreign investors. You can only access Saudi Arabia through indirect ways, not by investing directly in shares. And again, that market can open overnight if the authorities decide to do so. So again, and that is only showing what is already somewhat open to investors, but there are countries like Iran, obviously, which from political reasons are very closed, but it's a large economy. It's a country with 70, 80 million people. So again, projecting ourselves a few years down the road, there is no reason that at one point in time there might not be an opening of markets like that. So plenty of additional opportunities to expand the universe, but we already have a relatively diverse set of countries. When we, a few years back, we looked at, and it was in the context of the anniversary, the 20-year anniversary of the creation of the Emerging Market Index. We actually went back to discuss with some of the pioneers, the people that invested in the early 90s, late 80s into emerging market, and tried to discuss with them what was sort of the rationale at that time. And their logic, which was relatively consistent across these various investors, was really essentially a logic of saying there will be a catch-up. So I want to invest in a segment or in economies or in stock markets where there is a huge potential for catching up in terms of economic growth. That is linked to also a desire to go off the beaten track. So those countries at that time were very complicated to access, but it's the combination of the difficulty to access and the huge potential for growth that really attracted the early investors. And the potential for growth is still present. Whether it will realize and how quickly and which country will catch up and emerge and which one will stay is a different question. But purely in terms of the gap, we're not seeing really a closing of the gap. So when you look at most of the frontier and emerging countries, they still are pretty far from developed market in terms of their GNI per capita, which again is a measure of economic development per capita. The threshold that the World Bank sets is $12,000, and only a few of the existing emerging markets like Korea or the Czech Republic are starting to break out of this, out of this threshold. So there's been a lot of discussion about growth. So there's nothing new in saying that in aggregate emerging markets have grown faster than developed market, but it's also a very wide range of outcome. And so this graph is here more to highlight the diversity rather than the homogeneity of growth. So you will find, obviously more generally, in the higher growth category, countries that are in emerging markets, China, Chile, Poland, etc. But you do find also in the lower category other countries like South Africa, which has historically not grown as fast as other countries. If we look very high level and aggregating all emerging countries, you do see a loose relationship between the growth in GDP, so economic growth, and the growth of the emerging market index. And that's really one of the rationale people use to essentially have an allocation to emerging market. That is, again, why from an investment perspective, people then try to extrapolate that higher economic growth will translate in higher return, which has been the case for the last 20 years. And that is even on a risk-adjusted basis. So it's higher growth, it's higher volatility, but when you look at return per unit of risk, emerging markets have been returning more than developed markets on a risk-adjusted basis. That being said, the notion of relying on estimates for economic growth to structured portfolio is at least a difficult game, if not a very complicated one. And if you simply look at, here we've made an analysis over a relative long period of time of looking at GDP growth at the country level and link that to market return. And what you can see is really there is not much correlation or link between the two, and on the contrary, there tends to be an inverse relationship between the two. So even if on aggregate and historically there's been a strong link between economic growth and emerging market growth, when you actually go down at a more granular level, that link breaks down. One of the reasons, or there are actually many reasons for this mismatch. And by the way, this is not new. There's been a lot of academic studies looking at the link between economic growth and market return, and there's been a lot of discussion about this puzzle, if you want, that the two are not linked necessarily. But if you look a little bit deeper into that, you can see that there are so many intervening or interim variables to take into account in order to make that link, that it becomes more intuitive, that it is a little bit dangerous to only look at economic growth and infer that there will be higher return. One of those is obviously valuation. So if you invest in an asset which is growing, but you pay more than it's worth, you will not make a good investment, obviously. The role of consensus expectations and surprises. So a lot of valuation is driven by expectation. And again, if the expectations are fully reflected in valuation, then it's not necessarily a good investment. What is less well understood is that stock markets are not necessarily representative of the economy. So if you take, for example, the Gulf countries, their economies are obviously very much driven by oil, but if you actually look at the stock market, there's not a single security that is an oil-related security. They're all nationalized, and so even if you will find an exposure to oil, obviously by investing in the banking sector, because the economy is driven by oil, there is no direct investment on energy stocks in the Gulf. Then the element of the structure of the economic exposure of the companies themselves can be very different than the country. So you can see that when you aggregate all these dimensions, the link becomes much more tenuous. And to make the point further, just looking at a subset of emerging markets, which are the BRIC countries, which have been very much highlighted as the next generation of emerging market countries. You can see again that from an investment standpoint, the good returns that existed from 2000 to 2007 were essentially starting to get disconnected with valuation, and at that point in time, valuation or how much you pay for growth did play a role in an adjustment. And that's why more generally we'll look at it a bit later on in this presentation, but that's why our view is that what is important as a starting point is not to say, I've got an investment in my home country and let me pick and choose a number of high-growing countries in emerging market and structure the portfolio like that. We think that a portfolio should be structured essentially by looking at the available opportunity set, which is global. It includes emerging markets in it, so your starting point we think should be emerging markets, but then you need to be extremely comfortable of your forecastability to then start pick and choose each country, which is possible, but it becomes a very active decision. If we start looking a little bit at risk correlation, what has changed through time is the correlation. So 20 years ago, the two segments, developed and emerging market, were relatively disconnected, so correlations were low, and so there was a lot of benefits, diversification benefits in investing in emerging markets. As time passes, and also as the nature of the companies inside emerging markets have changed, they've become more global. The investor base have also evolved to be much more global. Then correlation has started to rise, and so at this stage there is not so much of a difference. There is still a benefit, but it's much less acute than it was many years ago, purely looking at correlation. What remains very different is the nature of the risk. So if you, and this graph is a little bit busy, but we're trying to compare essentially developed market on one side and emerging market on the other side, looking at some of the structural drivers of risk, which we define here as countries, sectors, and style. Style being investment style, like value, momentum, growth, these types of investment style. If you look at the developed market, what is striking is that actually there is no dominant style, right? So it ebbs and flows. Sometimes there is, the risk is more driven by countries. Sometimes it's more driven by sectors. Recently, it has been more driven by style, and in style you will find leverage, for example. So that may explain the rise of the blue line here, which is the importance of styles. But pretty much there is no dominant no dominant factor. Whereas in emerging market, the country dimension remains very important. And what does that mean in practice? In practice, what it means, among other things, is that a manager, for example, which may have been extremely successful inside developed market by, for example, focusing on stock picking, that manager or that investment style may not work very well in emerging markets, because if you're ignoring country risk in emerging markets, you will be burned. So you need either to be able to add value in selecting countries in order to add value as an equity manager in emerging markets, or you need to manage country risk in a very good way. But if you ignore that, then you will be burned at one point in time. And that has not really changed. It has declined a little bit, as you can see, but it hasn't really changed structurally. If you look at it from a different angle, which is more of a fundamental angle on the robustness of the institution, you can see also as well that generally emerging markets are less robust. The institution, the levels of corruption are much higher. The rule of law is sometimes shaky, and it is part of investing in emerging markets. There's been a lot of discussion recently about Argentina, the nationalization of one of the energy stock there. That is part of the, or that's an illustration of the robustness or the lack of robustness of the institution. In terms of the structure of the markets, sector-wise, you see essentially a high representation in financial, telecoms, and material. Again, logic, no surprise here. When you look and try to segment, for example, the types of economies within emerging markets, you will see that there are a number of them that are resource-driven. So that explains the sort of material dimension. But a lot of them are still pretty much running with not too much of an external influences. So I sometimes use the word autarcy, which is too strong, but there is an element of that. And in those markets which are not influenced by the external investors or by trade flow, you tend to see a market structure which is dominated by blank conglomerate. Very often those are controlled by families. The families have connections with the government, and that leads to a certain market structure which is in aggregate still reflected here. If we look at valuation, there's been a closing of the valuation gap through time, and in particular during the financial crisis. So we're back to this, in the eyes of the investors, globally, emerging markets have been perceived now as less risky, and as a consequence, investors are not ready to pay higher prices for those assets. What remains is a different level of return on equity and also different levels of growth expectation. So valuation may be similar between developed and emerging markets. The expectation and to some extent the profitability is also still there. If we look a little bit then beyond emerging markets, there's been a lot of discussion about frontier markets. It is a relatively new concept, even if the term frontier market has been used in the 90s. As far as an investment segment available for international investor, it is a more recent concept. It is very small, and that's why sometimes people make the analogy between frontier markets today, which are 0.4% of the universe, and the size of emerging markets 20 years ago, which was at that time 0.8%. So there's an analogy here. There's also an analogy in terms of the growth levels, which are higher generally in frontier market than in emerging markets. But there's still some structural differences which are I think worth highlighting. Before we get to some of the structural differences, just to give you a sense of what we're talking about when we look at frontier markets, we're essentially talking about countries which tend to be present in the Gulf, and with Kuwait, Qatar, and the UAE being the dominant segment. Again, Saudi Arabia is not open at the moment, so we're talking about mostly the three countries I mentioned in the Gulf. Africa, in particular Nigeria, is a big segment, and then Eastern Europe, Asia represent the rest of the segment. So again, when thinking about frontier markets as an opportunity set, it is heavily biased towards the Gulf countries, and that explains the performance, to a large extent, the performance differential between a frontier market and emerging markets, where frontier market have underperformed recently compared to both developed and emerging, and that's mostly due to the crisis that affected the Gulf countries, in particular the UAE, but more generally there has been a bubble and then a burst, and we're seeing the tail end of that burst reflected in the recent performance. Correlation have also increased, and that's due to the fact that those two the global crisis and the ones that is especially linked to the Gulf countries, happen at the same time, and they were not disconnected one from the other, and so correlation have increased in that context. If we look at the structure of frontier markets, we've got a little bit of the same story as emerging market, but more extreme. So you will see an even higher representation in financials. By the way, those institutions are different, in nature than what you will find in developed markets. So obviously in developed markets you will find banking institutions that tend to be global in nature. Most of the banks we're talking about here are local banks, really much driven by the local economy, and doing traditional banking, which is mostly lending for a margin. The next sort of dimension to have in mind when thinking about a frontier market is the notion of accessibility. So by definition, by construction, we will classify in frontier markets countries that are very hard to invest in. So they are very liquid. They very often have foreign ownership restriction. Generally, the infrastructure is not good, and when we talk about infrastructure, we're talking about the plumbing of getting shares in and out of a country. So there might be more risk in terms of the protection of the assets. There may be some issues with the ownership rights. So we're talking about investments that are very different than investments in developed market, where there's very little questioning whether you will on the ownership, for example, of the assets. If you invest, they're yours, and there's very likely to get back to you without questioning. It can happen in frontier market that there is questioning on the ownership. Just to illustrate that, simply on the level of float, so the shares that are available to investors, they're much lower than in emerging market, and obviously much lower than in developed market. And why is that important? It is somewhat different in nature to invest in a U.S. stocks, where essentially the total capital is owned by institutional investors. So the CEO, which tends to be an outsider or not family driven, is essentially accountable to shareholders, which are professional investors. There are a number of issues with that model, but at least there is clarity on that front. Versus in emerging markets, you're usually a minority shareholder with a majority one, which is either the state or a family, and that brings a lot of issue, good and bad. So the good one is there can be much longer term thinking, but the bad one is there's some leakage, here and there in terms of the influence of the family in the business affairs. So that's essentially what's available to investors investing directly in emerging market or in frontier markets. What we've tried to do is to actually think about a different way to accessing emerging markets, or capturing a different type of investment opportunity linked to emerging market. And that is really to think about the economic exposure of companies, and trying to actually invest or get an exposure to emerging market, but through the activities of companies based in developed markets. Why would you want to do that? There are really two reasons. One is you have a very different level of governance. You're still investing in a company that is governed by developed market standards. And you also get essentially an economic exposure that is different in nature. So intuitively, if you look at how an Indian consumer, for example, consume its goods, it will be more likely to buy goods that are actually coming from outside, versus the banking services are very likely to be local banks. And so when you look at the structure of markets, you will see in the Indian markets a representation of banks, but you will not necessarily find a very big representation of consumer goods. Versus if you look at European or North American companies, they do have a relatively significant exposure to emerging markets, but in sectors that are different. They are more consumer driven in particular. That's really what we're trying to measure and capture by looking at the revenue distribution of stocks. And here what we've done is look at every single company in the developed market, look at their structure of revenues, where it's coming from, and then relating that back to the various region. And what you can see is that over the last 10 years, roughly, the exposure, so the revenues generated by developed market companies in emerging market has risen from roughly 10% to 20%. So generally a much higher level of exposure, which you can translate into an alternative view of the world. So on the left-hand side, you've got the view which is the market capitalization view, so what is available to investors, and it is very much driven by the US. But if you look through at the economic exposure of those companies listed in those markets, then you can see a slightly different picture where emerging markets represent roughly 32%. So in those 32, you've got what's generated by the emerging market companies within their own countries or region, and what is generated by the developed market one. And that picture is much closer to the actual structure of the GDP or the economies globally. So how can you translate that insight into a different type of measurements or investment proposition? And here the approach would be to say, if you want to try to capture that specific exposure, then what you can do very simply is look for the companies that have the highest economic exposure to emerging market, and capture that into an index, which we've done. And the result is essentially an in-between developed markets and emerging markets. So this index, which takes the company exposed to emerging markets, but from developed markets, essentially has had return which were in between world and emerging markets, had volatility which was in between, and is essentially an alternative way to get an exposure to emerging markets. There are other mechanisms, but we're not going to talk about them today. But essentially, some investors have been using the actual GDP weight as a way to structure their equity allocation in order to anticipate the openings of market, and really making their allocation using economic weight rather than market cap weight. If we look now at the sort of last topic that I wanted to cover in the context of our review of emerging and frontier markets, it's really the question of how institutional investors are actually structuring that portfolio, and in particular how they get their exposure to emerging markets. What has been very striking and a very constant trend amongst the larger institutions globally, and has been this move away from what is called the home bias. So if you look at most investors tend to have a higher allocation to their domestic market than what is available to them generally. It generally makes sense to do so for fixed income for various reasons, most of them being that it's a good liability match for institutional or pension funds. But for the equity component, restricting to your home market make only sense if you believe that there will be more opportunities domestically than globally. And so this change in point of view, which is essentially a recognition that equities generally in portfolios are there to provide an exposure to long-term economic growth, and that is global in nature, has led most institutions globally over time to reduce their home bias, to the point that if you look at the largest pension funds in the US, for example, most of them now have no home bias. If you look at another country very advanced in that process, the Netherlands, similarly, Netherlands, which have no large defined benefit schemes, Netherlands in aggregate or the institutional investors in the Netherlands have no home bias. No, they're essentially investing using a global approach. So that's a major trend, and the consequence of that trend is also that we still have a large number of institutional investors that are underweight emerging market due to their home bias, due to the fact that they may be slow or perceiving emerging markets as more risky. But that perception or that logic of saying essentially the logic of saying I should only pick and choose internationally, that logic is really being questioned, and the new view of the world, if you want, is more to say that what's available is the starting point, and then you can obviously have views on certain region, but the starting point is essentially an exposure to the entire opportunity set. And that means that when you ask large pension funds, they still are looking at increasing their emerging market exposure, not necessarily to be overweight that segment, but simply to get to the way that is the neutral weight. And that's true for public pension scheme, endowments, sovereign wealth funds, and so on. So we've been trying to look then one step further and try to analyze what is happening when institutions are starting to allocate mandates, so mandates to manager, and we've tried to make a high-level segmentation where, on one hand, you can either capture your emerging market exposure through global mandates. So you are essentially saying, as a pension fund, as an asset owner, I actually don't want to make myself a decision on putting X percentage of my portfolio in emerging market. What I'm saying is that I will essentially let managers make that decisions, and I'm allocating a global mandate, so to an equity manager, which will have the discretion to invest in developed and in emerging markets. So that's what we call here integrated. Dedicated would be a mandate allocated to a specialist emerging market manager that will have then the discretion to invest within emerging markets, any region, any country. And then you've got more specialized mechanism, either to go beyond emerging markets into frontier, or this notion of picking the winner. So there's been a lot of discussions in the market about BRIC, about there is almost an acronym a week. So we've seen MIST, we've seen CIVETS, we've seen any acronym you can find is almost there, and it's all about trying to pool a number of countries with specific characteristics and essentially saying that those countries will outperform the rest of the universe. So with that segmentation in mind, we're looking here at the allocation in aggregate, and what you can see is that what has been dominant over the last few years is actually the integrated approach. where essentially mandates are allocated to global manager, not specialist emerging markets, but to global managers. And then the next big segment is dedicated, and the rest, picking the winner, pushing the boundaries, tend to be much smaller in terms of allocations. If you look at it from the angle of the added value of the managers themselves, you can see that there's one measure of the added value, which is the information ratio, which really looks at the added value of the manager relative to the opportunity set, so it's benchmark, and looking at per unit of risk. And that's really the information ratio, and the higher, the better. And what you can see is generally, you will find higher added value when mandates are broad. And again, that's intuitive, but it's good to see that in the results as well, is the broader the universe, the less constraint you put on a manager, the more dimension the manager can play with. And if there is skill, and obviously there's a big debate on whether there is skill, but if there is skill, then the skill then can be deployed much more effectively on a broader mandate. And you can see that in the results, which are essentially looking at institutional mandates over a roughly 10-year period. So if we wrap up this review of emerging and frontier, I think some of the key elements is the expansion of the opportunity set, the fact that now emerging markets are really central or completely integrated in the asset allocation process. They're not seen as a segment that you can ignore. This has meant that generally there's been a higher allocation by institutional investors, mostly when you get specifically to capturing emerging markets, mostly through this dedicated or broad emerging market mandate structure. And then the question is whether extending a bit further, whether frontier market would be an early stage investment that may lead to the same type of growth. That is obviously a forecasting statement, so I'll let you reflect on that, but I'll stop here. Thank you.
Remy, thank you very much. Great presentation. Thank you very much.